They called it the heartbeat of global finance, a single number that set the price of money itself. Mortgages, student loans, credit cards, all tied to Italiano. But what if I told you that number was a lie? For decades, the world's most trusted financial benchmark, the London Interbank, offered rate, or LIBOR, was secretly rigged by the very banks that ran it. A system built on trust was turned into a weapon of greed. This is the story of how the world's biggest banks fixed the world's interest rates and almost got away with it. In the 1980s, London was booming, the new center of global finance. Money was flowing fast, and banks needed a universal benchmark, a single rate to base their lending on. So they created Libor. Every morning, a group of major banks would report how much it would cost them to borrow from each other. The British Bankers Association would then average those numbers and publish the result. That one number, Libor, became the world's financial pulse. It determined over $350 trillion in loans and contracts worldwide. But there was a fatal flaw in the system. Libor wasn't based on real, completed transactions. It was based on opinions. And opinions, as it turns out, can be bought. By the 1990s, Libor was everywhere, affecting mortgages, car loans, and even government bonds. And traders quickly realized something dangerous. If they could move Libor, even by a tiny fraction, they could make millions. The first messages between traders marked the beginning of a global crime. They'd text each other, things like, "Hey mate, keep Libor low today." The reply would come back, "No worries, you owe me one." Each tiny, seemingly insignificant adjustment made someone richer. Each manipulation shifted billions in global value. It was subtle, invisible, and devastating. Emails uncovered years later revealed just how casual the corruption was. "I owe you a bottle of champagne," one read. Another said, "You scratch my Libor, I'll scratch yours." This wasn't the work of a few bad actors. This was the system itself. The traders didn't fear punishment because everyone was doing it. Menage a Snow executives knew, and as long as the profits kept rolling in, no one asked any questions. Manipulating Libor wasn't seen as fraud. It was considered a strategy. Then came 2008. The global financial system was collapsing. Banks stopped trusting each other, and lending ground to a halt. If the market were honest, Libor should have spiked, reflecting the soaring cost of borrowing. But it didn't. Libor stayed suspiciously low. Why? Because the banks were lying again, this time to appear healthy. By submitting fake low rates, they hid how much trouble they were really in. In the chaos of the crisis, LIBOR became an illusion of stability, a very lie that held the broken system together. In 2012, the truth finally broke. Investigators uncovered thousands of incriminating messages and call records. The evidence was undeniable. Barclays Bank was the first to fall. Regulators revealed they had been submitting fake Libor numbers for years. Their CEO, Bob Diamond, was forced to resign. Soon, other big names followed: UBS, Deutsche Bank, JP Morgan, Citigroup, and the Royal Bank of Scotland. The fines totaled over $9 billion. The damage to their reputation, pricey. For decades, the world's biggest banks had been fixing the price of money itself. So, how did it work? The method was terrifyingly simple. Each morning, a banker would enter a single number into a spreadsheet. That number represented what the bank asterisk claimed. Asterisk, it would cost them to borrow money. If enough banks colluded and lied in the same direction, Libor would move. That movement changed interest rates for everyone on Earth. 0.1% here, a fraction there, but across trillions of dollars, that meant millions in hidden profits for the banks, all from a number that should never have been trusted in the first place. When LIBOR's corruption was exposed, the shock was global. How could the entire world's financial system rely on a number that could simply be whispered into existence? Governments launched lawsuits. Cities, pension funds, and everyday investors demanded justice. People suddenly realized that their debts, their savings, and their homes were all tied to a rigged game. Public confidence in the banking system shattered. For the first time, the world saw the financial elite not as geniuses, but as manipulators. In the end, a few traders went to prison. Dozens lost their jobs. But the real architects of the scheme, the executives at the top, mostly walked free. They blamed the crisis on a few bad apples. But the truth was clear. It wasn't just a few bad apples. It was the entire orchard that was rotten. After decades of dominance, Libor began to die. Regulators announced it would be phased out, replaced by new systems like SOFR in the US and SONIA in the UK. These new benchmarks are based on real transactions, instead of estimates. But the question lingered. Was the problem really fixed, or just renamed? Because systems don't create corruption. People do. Fast forward to today. We have crypto markets, algorithmic trading, and AI-driven finance. We're told these new systems are fair, transparent, and but that's exactly what they said about LIBOR. We've already seen stablecoins lose their pegs, crypto exchanges manipulate prices, and algorithms create flash crashes. The technology has changed, but the behavior hasn't. The lesson of Libor is simple. When money and secrecy meet, truth is always the first casualty. The smallest change in LIBOR, just 0.25% moved $10 trillion in loans. For an ordinary homeowner, that meant higher mortgage payments. For students, bigger debt. For taxpayers, billions lost in inflated government borrowing costs. While ordinary people paid the price, the traders celebrated with champagne. One tiny number with global consequences. LIBOR's collapse wasn't just a scandal. It was a revelation. It proved that even the foundations of modern finance, things we assume are objective, are built on human trust. And trust can be corrupted. This wasn't just about greed. It was about control. Who sets the price of money? Who decides what debt costs? Who profits from a single percentage point? Those questions still define our world today. There are 3 key lessons from Libor. First, the market isn't rational. It's human. Behind every financial formula is a person making a decision. Second, transparency isn't a luxury. It's essential for survival. Without it, even the most advanced systems become corruptible. And third, history never truly ends. It just evolves. Libor may be gone, but the temptation to manipulate the system remains. Right now, in some office tower, another benchmark is being set. Another algorithm is determining what your money is worth. And the world trusts that number, just like it trusted Libor. The next scandal might not be about banks. It might be about data, or crypto, or AI. But the core truth will be the same. Where there is power without oversight, there is corruption. If you found this story eye-opening, please share it. Because history only repeats itself when people forget. Subscribe to our channel for more stories of greed, power, and the secrets behind the money we trust. And remember, the next time you hear about the market deciding, ask yourself, who really decided?